On today's Portfolio Builder, we find out how options can be part of your portfolio. We're going to get this information from Montreal Exchange Senior Manager of Equity Derivatives, Ron Hochman. Ron, thanks so much for joining us.
Thanks for having me, Kim.
That's a big number, 48% up over last year. How come?
I think a lot of it has to do with the current market rate environment. If you look at the fixed income market, for instance, yields are extremely scarce. If you look at cash, not paying anything, 5-year government of Canada bonds are yielding about 1.5%. 10-year, you're looking at 2%. Corporate bonds are very scarce in Canada. Then you look at the equity markets. I think investors are still weary being in the equity markets, and that's why you're seeing some cash on the sidelines. What we've noticed at the exchange are investors gravitating towards yield enhancement type strategies. So either dividend-paying stocks or cover call type strategies where you're generating cash flow on a regular basis or tax-efficient cash flow, or a combination of the two. So if you look at some of the Canadian financials, for instance, most notably Canadian banks that are yielding 4 to 5% in terms of dividend, add a cover call type strategy to that, and you're looking at anywhere between 10 and 15% a year, which isn't too shabby as far as market returns in this environment. So yeah, all around we had a phenomenal year, and I think the growth has come both from the retail community and institutional investors. So pension funds managers, hedge fund managers, insurance companies, all implementing these types of strategies to generate much needed yield. So yeah, we're definitely reaping the benefits of this market environment.
Ron, you mentioned a whole bunch of things there that I want to break down. Covered calls being a great way to get some yield for investors, but let's start even a little more basic. Puts and calls are the two options out there. What is a put and what is a call?
As far as put option basically gives the holder the right but not the obligation to sell a specific quantity of shares at a predetermined price. So basically you're paying a premium to lock in the sell price today for some time in the future. And a call option basically gives the holder the right but not the obligation to buy a specific quantity of shares at a specific price for a specific period of time. So in this example, you're basically paying for the right to lock in a purchase price for some time in the future. Okay,
let's talk about one of the, I'd say, safer option strategies, because we should just highlight for everybody. I mean, options are riskier for a lot of people than equities. You can debate that with me, but let's just start with a covered call writing strategy. How does it work? Give me an example of how it might work.
Perfect example I took from last week. So Barrick was trading at about 49.65. An investor that wanted to sell Barrick at 50.
And let's just be clear, this is somebody who already owns shares of Barrick, right?
Exactly. This is somebody who owns shares, so either you just bought shares or you've owned shares for a while. The stock's trading at 49.65. You're comfortable selling the stock at 50, so rather than placing a limit order, why not just generate some cash flow in the process? So in this example, we're selling the calls. We're selling the $50 calls for $2.15. By selling the $50 call.
I'm just going to keep backing up here. So by selling the calls for a $50 call at $2.50, you're essentially selling the right for someone else to buy those shares at $50.
Exactly. So you're committing to sell the shares at $50 if the share increases in value by expiration. So if by expiration the stock is above $50, you committed to selling the stock at $50. But in return, you basically generated $2.15 in premium. So what that $2.15 does for you is basically gives you further upside appreciation. So if you're committed to sell the stock at 50, well, you sold at 50, plus you generated $2.15 above and beyond that $50 strike price. If the stock does not hit 50, well, you can simply keep your $2.15 and either walk away or sell calls for the next month.
Got it. Okay. And again, that's great for someone because you own the stock. It's a way to kind of get some income. It's almost like income on a property. If you own it, you might as well rent it out for a little while in the same sense.
Exactly. So rather than simply relying on capital appreciation in the stock, if you look at the S&P, for instance, or the TSX, S&P is basically flat. If you go back 10 years, we're at the same levels today as we were 10 years ago. If you look at the TSX, we're at the same levels today as we were 5 years ago. So rather than simply sitting around and being passive and relying on capital appreciation in the market, why not be active and generate cash flow in the process? And I actually used Barrick at the same time last year when I was on BNN, and I used the very same strike, $50. So the stock was basically trading at around the same price a year ago. So again, you don't want to simply rely on capital appreciation in this type of environment.
Okay, let's try and get the inverse example. This is using Barrick again, and this time you have an example of something called a secured put. What's a secured put?
Secured put is the exact opposite. So in the previous example, somebody was actually paying you to sell your stock. in this example, somebody's paying you to buy a stock. So in this example, Barrick was trading at $49, and I wanted to buy it at 48. So rather than putting a limit order of 48 and waiting for the stock to hit 48, why not generate some income in the process? So by selling the $48 put, in this example, I collect $2 in premium. What that $2 does is lowers my average. So if I get assigned on that stock and I'm forced to buy that stock at 48 at expiration, my average cost actually becomes 46. So it's that $48 minus that $2 collected for the premium. If the stock does not hit $48 at expiration, well, I simply keep my $2 premium, and I can either walk away or sell puts for the next month. So it basically gives me a cushion on the downside.
And just to be clear, sorry, with this stock, if the stock did drop, it's saying you could buy the stock at 46. You have to have the capital to buy that stock. Is that correct? Yeah,
so for the position to be secured, you do have to have the capital to have the stock. And let me add one thing. And the one good thing about these types of strategies, cover call, for instance, it's a good substitute for dividends. So not every single stock in the TSX pays a dividend. So you're basically creating a synthetic dividend on a stock. So we list options on about 300 different names. So rather than simply relying on dividends from stocks, this is an excellent way to generate synthetic type dividends.
I've only got literally 10 seconds here, Ron, but when you said that 48% increase in volume right now, options trading is up. Do you know where that volume's coming from? Is it retail investors? Is it institutions?
It's a bit of both. Let me just clarify one thing. As far as the 48%, that's strictly on equity options, but it's a mix, both retail and institutional investors.
Ron, great having you with us. Thanks so much.
Thanks for having me, Kim. Have a good day.
You too. Ron Hochman is Senior Manager of Equity Derivatives at the Montreal Exchange.